Now, next year, the current expansion, which began after the global financial crisis in 2009, will be 10 years old. That will make it one of the longest periods of sustained growth in U.S. history. Expansions don't die of old age, but after such a long period of growth, strains typically do start to show. In the last few weeks, financial markets have been very turbulent, reflecting in part concerns that this long expansion may indeed be coming to an end. The Dow Jones Industrial Average is off around 10% from its peak of a couple of months ago, as investors fret about a number of issues that could derail the economy. U.S. China trade relations, rising interest rates, uncertainty in Britain over how the country will finally exit the European Union, if at all. There are political worries too. This week, we witnessed a testy Oval Office meeting between President Trump and the Democratic leaders of the House and Senate, where President Trump suggested he was quite willing to shut down the government next week over funding for a border wall. All this comes ahead of a Federal Reserve meeting next week, where the central bank is expected to raise interest rates again. But beyond that, the outlook for rate increases is becoming less clear. So, might we be headed for a recession? Joining me now to talk about all that is someone who is worried that a recession may be looming. She's Liz Ann Sonders, Chief Investment Strategist at Charles Schwab. Liz Ann, thank you very much indeed for joining us. Can I start by asking you, thank you, can I start by asking you what's behind this current volatility that we're seeing in markets?
So I think there's two factors that are oft discussed and I think well known. You touched on them in your intro, obviously uncertainty with regard to trade, also Fed policy specifically, but maybe financial conditions more broadly. And you could clearly point to both of those things as starting to trigger what we saw begin at the end of September, which is this now kind of almost back-to-back 10% corrections as we close the year. But I think more recently there's one that's come to the fore, which is some underlying deterioration in some of the leading indicators in the U.S. economy. You see it in some of the housing data, notwithstanding this week's move back down in unemployment claims, a 3-month uptrend there, the lengthening of the average work week, the stock market, which is a leading indicator, maybe telling you there's some cracks under the surface. It means we want to start to look at additional signs that a recession could be sooner than what I think the consensus believes.
But the economy overall, the data have been generally good, right? We had very strong growth for the early part of this year. Looks like we're still going to have maybe a softer growth in the fourth quarter. But we're a long way, aren't we, from an actual downturn?
Well, keep in mind that when it comes to the relationship between economic fundamentals and the stock market, what I think trips up investors quite often is whether we're Main Street people or investors, we think of economic data, GDP or job growth, in level terms. Is it good or bad? Is it healthy or unhealthy? Where the stock market tends to pick up on rate of change. That's why I've always said better or worse matters more than good or bad. So that's why I reference some of this underlying deterioration, some of these potential inflection points under the surface that tell you we may be seeing growth start to roll over. We did a very strong second quarter, over 4% GDP growth. A lot of that, though, was activity that was sort of front-running the institution of the tariffs, so we sort of borrowed some growth from later in the year. Expectations are now just only for a little more than 2% in the fourth quarter, and not terribly strong growth looking into 2019, too. I think the other factor looking into 2019 is that the earnings growth story, which is obviously very important for this market, is deteriorating quite a bit because we no longer have the year-over-year growth burst from a tax cuts perspective. And we've got a lot of potential hits in 2019, tariffs and trade being one of them, but also the contraction in oil prices, which is yet to be reflected in the energy sector and related areas. So I think that's another weak part of the story for 2019.
You talk about tariffs and trade, and everybody's very focused on this. Everybody's worried about what may happen. But trade is still, even if we get into a trade war, you know, the amount of trade that could be affected is a very small part of the overall economy. You know, maybe fractions of a percentage point of growth. Why would those concerns tip the economy potentially over into a recession?
Well, it's actually a fairly large percentage when you take into consideration the fact that if we go to the full 25% tariff amount on everything that we import from China, the follow-on question is, because U.S. companies are paying that additional tariff, that's a tax on U.S. corporations, how do they reflect that looking forward? Do they eat it in their profit margins, which then becomes a growth story? Do they decide to pass those higher costs on to the end consumer? Do they opt to sort of contract their business looking ahead, hold off on capital spending plans? even if you just do the simple math.
I'm just trying to understand why what is a relatively small amount, how it affects the overall economy.
It's not. If you look at the consensus across many economists who are looking at this, if we go to the full 25% on the full $500 and change billion worth of goods that we import from China, it's a little more than 1 percentage point of GDP, and that's the direct impact on the economy. If we're down to a 2% growth rate in 2019, you cut that in half, that's a meaningful impact, which doesn't take into consideration the ripple effects through the business confidence channels, through the consumer confidence channels, through the potential inflation channels. So the numbers, the simple numbers, which is an objective look at the math, is a pretty meaningful impact on GDP. You can't just look at the percent that trade is in terms of the U.S. economy or global economy, but the dollar amount divided into GDP is a percentage point off of growth.
Right, and I get it. It's in effect, it's a tax increase actually on U.S. consumers, well, ultimately on U.S. consumers presumably pay it, which is always negative for growth. I'm just trying to get a sense of the scale, and I wonder whether the concern is this extraordinary expansion that we have seen in global trade over the last 25 years with all of the benefits for global supply chains, that could be at risk. And there's concern about that, isn't there?
Absolutely. This is a much, much more complicated global supply chain, which is why the impact on many U.S. companies goes down the capitalization spectrum, too. And one of the reasons why smaller cap companies are underperforming larger cap companies is because they're more exposed, given this global supply chain and how much more intricate it is, than a lot of people assumed would be the case when we first started down this path toward tariffs. And the impact overall on world trade, if you do that percentage point representing U.S. growth, the impact on world trade is quite a bit more than that. And that it may be ultimately we look back at the end of whatever the period is and say it was all worth it because then fill in the blank, there's, fairer, freer trade, and China has moved back on some of its more nefarious practices. But we also have to be mindful of the cost in the interim to the U.S. economy and to the consumer, especially if we continue on with the full amount of tariffs as proposed.
What could be done to offset the negative impact that we could have from an actual trade war?
Well, the Federal Reserve certainly could step in to the extent that you move toward the full tariff amount, and it does start to have a more meaningful impact on GDP growth, and has already been the case. The rub, of course, is that if it causes a faltering in economic growth, but in turn starts to cause an increase in inflation rates, then that puts the Fed in a little bit of a pickle, because the Fed is the only central bank globally that operates with a dual mandate of full employment and price stability. And one of the rubs with tariffs is if it causes some weakness in the economy, which could lead to weakness in employment, but it also causes a pickup of inflation, then the Fed is in a little bit of a pickle because they've got their two sides of their mandate working against one another. But it certainly is the case that especially if we see a significant enough deterioration beyond what we've already seen in global growth and it starts to infect the U.S. economy, then the Fed would likely pull back on raising interest rates, and you could see an easing of financial conditions, especially if the dollar were to start to weaken. That's been another story of 2018.
I'm going to have to cut you there, but very quickly, just a very quick answer. What kind of probability would you rate the possibility of a recession in the next year?
Well, there's a 100% chance we're going to get another recession. Yes, in the next year, I do think trade holds the key. I think it's the key to the span, right? I think the key to the length of runway between now and the next recession, to a large degree, does relate to trade, and hopefully we'll have some answer to that in the next few months.
So still
beyond
unlikely,
that, I think we could make it
unlikely in the next year recession, you think, still?
I think an earnings recession next year is more likely than an economic recession, unless we kind of continue down the rabbit hole toward the full amount of tariffs.
Great.